Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Right there. See it on the shirt? It's a logo. It's like subliminal advertising, just constantly. Just check it out. Right on the homepage, actually, you can learn everything about us, including what it costs to work with us, because why are other advisors hiding that? Anyways, side topic there. Today, we're going to do a little bit of a personal finance talk. I know this is not going to fit everybody, and by no means am I saying, I'm Dave Ramsey, I know everything about everybody, and you do this. No, I'm just presenting a scenario. My goal is to get you to think while teaching you. If I could teach you something new and causes you to go, is that me? Should I do that? I won. That's it. I don't need you to subscribe. I'd like it if you did. I don't need the thumbs up. I'd like it if you did. But if I can get you to do that, maybe you'll ask us the question. Maybe you'll ask another advisor, and somehow I'm helping other advisors, and I never knew it this whole time. All right, so let's get into it. Is this the time to take a loan from your 401k? Ooh. It's a good one there. A lot of people think, oh, you shouldn't take a loan from your 401k. That's not necessarily true, right? We could come up with a really simple example to prove that you should take the loan from your 401k. One simple one is the stinking credit card rates. You're like 30% on credit cards. I see it. I'm watching all the clients out there. I see their rates changing. Well, what if we took a 401k loan from that, pretend that everything else that you could possibly combat with this phrase is fine. We're not going to lose our jobs. We're healthy. All is good. We have other insurance. All that's fine. Let's just pretend. Okay, a 401k loan, maybe 8 or 9% now, depending on your carrier there. That's your 8 or 9%. You're paying yourself back that 8 or 9%, or 8 or 9%. So let's say you got $10,000 in credit cards charging you 30. Well, this is a really simple one. I'll take the 401k loan. I'll pay off the credit card. Don't go racking it up again, right? And then I will pay back myself at 8 or 9% or whatever it is into my 401k. The catch there, I get it. I know there's a lot of little angles we could go down here, trust me. But for most people, the catch is, well, if the market goes up more than the interest rate you paid while you're paying it back, all right, you lost a little money. But did you lose 30%? No, right? So the real answer there is if the market goes up 30% in a year, right? Take you a year to pay it back, let's say. Shoot, anything over that, it's like, well, I should have just paid the credit card company. Or is it? No, it's still not a big deal because you would still be paying yourself back the interest and not the credit card company. So it's a win-win over here. So really the stock market has to be up over 37% during the time that you take out that loan. Just throwing it out there. You want to leave a comment? How many of you think that from this point right now where the stock market is, another 37% is going to happen? 38, 39%, somewhere in there. Yeah, I don't know about that, right? So in this case, a really simple example, you go, it's cut and dry. I get it. I'm paying back myself. Yeah, the whole thing, I get it, right? So let's think of it like that. What I'd love for people to do is to think of their finances like a balance sheet. I know it's boring and people don't want to do it, but hey, Apple's out there doing it. Apple is looking at their balance sheet. They're not looking at where they take one insignificant little loan from. They're looking at the total balance sheet. And as long as that translates into more and more profits, or at least stable profits, they won, right? Could you not be making yourself a profit by potentially taking a 401k loan? And before you say it, we're not in the business of 401k loans. I get nothing for sharing this with you. Just trying to get you to think. There's no penny that's going to come my way from you doing this, or at least considering it, right? So there you go. Also, I'll throw out another one. Let's just say you took out a 401k loan, and in your brokerage account, you had a line of credit. I know it's really popular. You guys are doing it. I see it. It's out there, right? We do that for our clients. Goldman Sachs actually sets it up. You could borrow against your own brokerage account, not take the capital gains, blah, blah, blah. It's a different video. But let's say that that's the case. Well, what happens if while you have the 401k loan out, you're making payments, okay, and then the stock market falls, and you've got your line of credit, I'm assuming just some small amount or whatever, and the market falls. Is there not a game to be played there, right? I'll leave you hanging on that one. Think about it. Get your brain working a little bit. There are 3 different things happening. Could we not have an advantage to one side of it, particularly the 401k loan side? Yeah, there you go, right? So just think this through, right? Just an extra little thing for you to go, oh, this guy, he's always putting thoughts in my head. I'm happy to help.